Welcome to the financial heartbeat of the modern world. What you are seeing is not just a room full of screens and shouting people. It is the central nervous system of global capitalism. This is where fortunes are made, where retirement funds are built, and where the future of industry is decided every single second. We often hear the phrase, the market, tossed around in the news. The market is up, the market is down. But what is it really? Is it a casino, a science, or something far more fundamental? To understand the world we live in, we must peel back the layers of this complex machine. Over the next hour, we are going to dismantle the myths and look at the mechanics of the stock market. At its simplest level, the stock market is a marketplace for company ownership. When you strip away the jargon, we are talking about buying and selling shares that represent actual pieces of businesses. Think of a supermarket. You go there to buy food. The stock market is exactly the same, but instead of buying apples or milk, you are buying pieces of companies like Apple and Nike. These pieces are called equities. Why does this system exist? It serves a dual purpose. On one side, companies use it to raise capital for expansion. They need money to build factories, hire workers, and invent new products. On the other side, investors, people like you and me, use it to build long-term wealth through strategic ownership. It is a symbiotic relationship that drives human progress. But how does a company get to the stock market? Most businesses start as private entities. The transition to the public stage is a monumental event known as the IPO, or Initial Public Offering. This moment marks the specific point in time when a private company becomes publicly traded and sells its shares to the world for the very first time. It is often celebrated with bells and fanfare, but functionally, it's about resources. By going public, companies unlock massive cash injections. This isn't just pocket money. It is the fuel required for ambitious growth plans and expansion into new markets worldwide. Once a company goes public, the trading begins. But not all trades are the same. We must distinguish between the primary market and the secondary market. The primary market is where the company sells new shares directly to investors. In this scenario, the money flows directly to the business to fund its operations. Think of this like purchasing a brand new car straight from the manufacturer's showroom. However, what we see on the news every day is mostly the secondary market. Here, investors trade existing shares amongst themselves. The company doesn't get this money. It circulates between people. This is similar to buying a used car from another owner through a marketplace. Where does this trading physically happen? For centuries, one address has dominated the financial imagination: the New York Stock Exchange. Founded in 1792 on Wall Street, this institution is steeped in history. It features the iconic trading floor we know from movies, complete with the opening bell ceremony and the American flag. This is the home of the establishment. It hosts established blue-chip corporations, the titans of industry like Coca-Cola and Walmart. These are the market leaders that have stood the test of time. But the world changed. In the late 20th century, a challenger emerged, the Nasdaq exchange. Launched in 1971, this was the world's first fully electronic stock market. Unlike the NYSE, the Nasdaq has no physical trading floor required for transactions. It exists in the ether of digital networks. Because of this digital DNA, it became the natural home for the future. It is renowned for technology giants and growth companies. When you think of Apple, Google, and innovative startups, you are thinking of the Nasdaq. You cannot simply walk onto the floor of the NYSE and start shouting orders. You need a gateway. You need brokers. Brokers act as your middleman. Their job is to execute your buy and sell orders because you cannot trade directly on exchange floors. In the past, you might have used full-service brokers who offered personalized advice but came with higher fees. Today, the landscape has shifted to modern trading platforms. Popular platforms like Fidelity, Robinhood, and Charles Schwab offer intuitive mobile interfaces. Now, discount apps provide low-cost access, allowing you to tap a button on your smartphone and instantly execute trades worth thousands of pounds. Behind the scenes, there is a player you rarely see but cannot function without: the market makers. They are the invisible hand of the market. Their role is to ensure liquidity by holding stock inventory. Imagine trying to sell your shares, but no one is buying at that exact second. Without a market maker, you would be stuck. They enable you to buy or sell shares instantly, anytime. They don't do this for charity. They profit from the spread, the tiny difference between the buy and sell prices. They facilitate the flow, preventing hours-long waits for transactions. How do we know if the market is doing well? We use indices. The oldest and most famous of these is the Dow Jones Industrial Average. This is America's oldest major market index, dating back to 1896. However, it is surprisingly exclusive. It tracks just 30 massive corporations. The Dow uses a price-weighted system. This means that companies with higher stock prices command greater influence over the index. Because of this small sample size and odd weighting, it is often criticized for not being a true representation of the entire economy. If the Dow is the grandfather, the S&P 500 is the standard. The S&P 500 index tracks the 500 largest publicly traded U.S. companies. Unlike the Dow, it uses market capitalization weighting. This means the larger the company's total value, the more it matters. Because of this breadth, it provides a much more accurate representation of the market. It is widely considered the definitive indicator of overall American economic health. It is the benchmark for retirement funds globally. For those looking at the cutting edge, we turn to the Nasdaq Composite Index. This index monitors over 2,500 stocks listed on the Nasdaq exchange. It is heavily weighted towards technology and biotech sectors. Because it is filled with growth companies and startups, it behaves differently. It exhibits higher volatility with rapid price movements. If you want to know how the risky, high-growth part of the economy is performing, this is the essential gauge. The market breathes in cycles of emotion, defined by two animals, the bull and the bear. A bull market is a time of rising prices. It is characterized by widespread optimism. The bull attacks upward with aggressive momentum. History tells us something encouraging. Historical data reveals bull markets endure longer periods than their bearish counterparts. But then comes the bear market. This is defined as a period where prices decline more than 20%. It happens amid pervasive fear. The bear swipes downward in defensive retreat. Ultimately, market psychology and investor sentiment are what drive these cyclical patterns. When you decide to trade, you have choices on how to buy. The most common is the market order. This is an instruction to buy or sell immediately at the best available price. It guarantees execution without delay. However, there is a trade-off. You sacrifice price control for speed. In a fast-moving market, the price might change slightly in the split second before your trade goes through. It is ideal when entering or exiting positions urgently. For the disciplined investor, there is the limit order. This offers price control. It is a strategic instruction to buy only if the price reaches your specified level or better. You set the terms. The risk here is patience. The trade may never execute if the stock doesn't hit your target. But for those practicing disciplined strategic buying, it ensures you never overpay. How do you actually make money? The first method is capital gains strategy. This is the classic buy low, sell high. You profit from stock price appreciation. For example, you purchase stock at £10 and sell at £50. That margin is your profit. But be aware of the taxman. Short-term gains are often taxed higher than long-term gains. Crucially, Gains are only realized when you actually sell the shares. Until then, it's just paper money. Strategic timing and patience can dramatically amplify your investment returns over time. There is a second way to earn, one that requires less timing. Dividends. Dividends are the ultimate form of passive income. This is when companies share profits directly with shareholders. These are typically paid quarterly, every 3 months, like clockwork. Think of this like collecting rent on property you own. Even if the stock price doesn't move, you get paid. It is excellent for generating stable passive income streams. To respect the market, we must understand its darkest days. We must look at the 1929 market crash. On Black Tuesday, October 29th, a devastating collapse triggered the Great Depression. What caused it? Excessive margin buying, people borrowing money to gamble on stocks. The results were catastrophic. The market lost 90% of its value over 3 years. Millions of investors were financially ruined overnight. It serves as a permanent reminder of the dangers of greed. Closer to our own time, we face the 2008 financial crisis. This time, it wasn't just stocks. It was the housing bubble bursting, combined with a subprime mortgage collapse. When the investment bank Lehman Brothers filed for bankruptcy, it sent shockwaves globally. Markets plummeted 50%, triggering the Great Recession. The human cost was immense. Millions lost homes, jobs, and life savings. So what causes these movements? There are 4 main drivers. First, supply and demand. This is the ultimate rule governing all price movements. Simply put, having more buyers than sellers drives prices upward. Second, earnings reports. These are quarterly results revealing company profitability. If a company beats expectations, share prices soar higher. Third, macroeconomics. Things like interest rates, inflation, and employment data act as economic indicators that influence investor confidence dramatically. And finally, sentiment and hype. Never underestimate market psychology. News headlines, tweets, and rumors can override fundamentals temporarily. As we conclude, remember the balance of risk versus reward. Stocks offer high potential rewards, but they come with corresponding volatility. Bonds provide stability, but with modest returns. The secret to survival is diversification. This spreads risk intelligently across different assets. And perhaps the most important rule of all, time in the market beats timing the market consistently. It is not about guessing the lucky day. It is about staying the course. Thank you for watching.